Hi, everyone. This is Brian. I just want to take some time to talk a little bit about retirement and Wall Street and the facts of the numbers that they publish. Sometimes they're a little bit sleight of hand with some of those numbers. Numbers can lie, sort of thing. So before you start investing in mutual funds or any insurance products or IRAs, 403bs, let's take an honest look at some of these numbers, okay, that can be deceiving. Don't let the published numbers that the money managers who are, they're trying to get your money so they can make fees and commissions off you. Whether you make money or not, they're making money. So they have an incentive to publish numbers that are favorable to their cause, not yours. So get the facts, draw your own conclusions. So here's some simple math. If you start with 1,000 in 1 year and you earn 10%, which is a good return, your new balance is 1,100 at the end of year one. There's the math. Well, you made $100. That's great. 10% is a great return. But what if you lose money the next year? You lost 10%. Your new balance is actually down $10. So you've wasted 2 years of your life. You made 10% 1 year. You lost 10% the next year. Sounds like your average is zero, right? That's what they'll tell you. But you actually lost money. How can that be zero? So that's one of those little sleight of hand. You actually lost $10 in 2 years. Wall Street would say you had a 0% return, but the actual return is -1. So what they're doing is they're giving you the average, the arithmetic mean. It is zero. It's not a lie. It is zero. But we're talking about money here. There's negative numbers here. And that negative number showed you lost $10, which is a -1%. So you got to know the difference between what they're publishing, which is an average return, from the actual return. So why would they do that? You figure it out. Here's an example of if you lose a chart that if you lose a certain percent in 1 year, what do you need to make up for it the next year? So let's go to 10%. If you lose 10% 1 year, you need 11.1 the next year. That's not easy. Let's go to 20%. You lose 20% 1 year, you got to make it up next year, making 25%. This is getting near impossible. And down here was the 2008 real estate debacle. You lost 40%. A lot of people lost half their IRAs. You get 66%. That could take 5, 6, 7 years to make that up. But again, if you're going to spend 5 or 6 years trying to make it up, that's 5 or 6 more years of possible black swan events, excuse me, like a 9/11, like the real estate crisis, like a flash crash. Even just this past week, this month, the market lost like 10%. So, do you want to be in that environment? I say no. I'm going to try to show you a vehicle where you're not going to be affected by, look at this roller coaster of the market here. It's up, it's down, it's green, it's red, it's up, it's down, it's green, it's red. When are you sleeping? When are you going to retire? I don't know when you're going to retire. If you're planning on retiring, say a year from now, can you promise me your money's going to be there? No. Can a money manager? No. Can a financial advisor? No. Nobody can promise you that. This chart right here should tell you you don't belong in the market. It's a casino. This chart shows you 2008 specifically. It was down like 38%. It's going to take 66 to 67% for you to break even. And it didn't happen. It didn't happen. It didn't happen. Maybe the combination of all these got you to even, but that's just a rear view mirror. It could have easily gone down further. Here's my rules for investing. Capital preservation. You got to save your money at all costs. Nobody can time the market, not even Buffett. Beat inflation. If inflation's 2% and you're making 2% on your money, you're even. You didn't beat inflation. So how can you beat inflation? And you can't live in the danger zone. The danger zone is being in the market. And if you're in the market, say 7 to 10 years before you retire, you are taking a lot of chances. You got to cut your taxes. And why do you want to put your money with a money manager when 75% of the money managers can't even beat a passive index fund? Why are you paying them fees? I never got that. You also never have a red year. And again, I'm going to reiterate, preserve your capital. Is there any vehicle that's 100% perfect? No. But I came across one that comes awfully close, one that has growth, one that beats inflation. Safety. It's out of the market casino. Capital preservation at all times. There's never a red year. You get that? Never a red year. No sleepless nights. No market timing. Took me a really, really long time to find this product. It was a difficult journey, getting pulled here and there. I had to read between the lines. I had to filter out so much to find this product, and I finally found it and want to share it with you. I would share it with my friends, my family, my neighbors, my loved ones, okay, because that's how good the product is. If you want to learn about this product, contact me at brianquigley120@gmail.com. to learn about this wise investment vehicle. Stop gambling. Stop putting your money at risk. Get out of the market. Pension funds don't use it. Insurance companies don't use it. Why should you? Hey, thanks for your time. I hope this was a valuable use of your time. It took a lot of time for me to find such a product, so please get in touch with me so you can learn all about this product before you lose any of your money in the market casino. All right, take care.